Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning. Thank you so much for tuning in to Become Sensible. Today we talk about a topic that so many people have a question, that is the tax implication of owner distribution. In other words, is how to pay yourself and how it affect your tax situation. This can make a difference in how you manage your personal finance and also your business, and also it's affect a lot in terms of your tax. So we will break it down on the basis the different method to pay for yourself and explore how this joy impacts on your tax situation. By the end of the podcast, you'll have a clear picture of the option of compensation yourself as a business owner. So let's dive in. So first, let's start with like what distribution mean. It mean that when you are a business owner, whether you call it owner drawer, shareholder distribution, partner distribution, is all mean the same thing. That you move the money from the business and pay it to the owner. This can be in the form of check, wiring, deposits, whatever is payment method it is, but it's important to know that distribution are different from regular business expense. So distribution is not a real business expense at all, and this is not like a deductible item or a business expense on profit and loss, but instead, like distribution is a equity transaction. So if you remember on the episode I mentioned about the balances, some balances including asset, liability, and then equity is at the bottom of the balance sheet. So anything that you do on a distribution normally show up on over here, and it's very much affect in the way that like how your basic in the business change. What is the basic? Basics is basically like the contribution to the business when you start a business and contribution during the year. It add anything that your business make the profits and it's minus any distribution to you, and then it's come with the final equity in the business. That is your basics. So anytime that you make a distribution for yourself, it reduces your basics. Anything that you contribution to the business is it increase your basics. So that is that. And because it's an equity transaction, so it's not like change your like whether you pay tax on that. It depends a lot on the entity type, which we will talk in the next like couple minutes. So let's talk about like what is the owner distribution and then the payroll. So owner distribution or owner drawer is basically like a method that you pay for yourself, but this is not to payroll. So there's no withholding tax for the state and federal on your payment at all. And you can draw yourself like as often as you want to and draw them while it may increase your overall tax liability because there's no withholding tax on the distribution. While the payroll for the owners and payroll is not happen for every business entity, and that is why your business entity is very important. But normally payroll is happen with the people who has S corporation and C corporation. And when you have the payroll, you basically have withholding tax on this paycheck. It also helps you to have a like very stabilized, like predictable earning income like every single month. So it's easier for you to manage the personal finance. But payroll come with the requirement of like stabilized cash flow situation. So if you don't have a very good cash flow, a predictable cash flow situation, it's very hard to run the payroll for yourself because you don't have enough cash to actually cover the payroll and cover other expense. So it's like a tie together in terms of like cash flow. The next one, we talk about a real life example. Like, for example, Patty, she owns an S corporation, and because she's a S corporation owner, she can pay herself some salary, and she decided that she make the payroll for herself $2,000 per month, and then any like after that, anything that she need for her personal spend, she will take it at a distribution, and this will like give her the flexibility that she can have a predictable income coming every single month on her personal side, but it also give her the flexibility in terms of the business that not pay herself too much. And then the other thing is all of us have a challenge in terms of earn income because anything that you earn under earn income, there's no like there's less deduction come with it, and therefore earn income normally in the highest tax brackets and also like in the most challenging situation in terms of how to reduce your taxable income. So if you pay yourself a lot high salary in the W-2, which is normally on the top ones in your W-2. It's put you in certain tax brackets, and there's less deduction, of course, less standard deduction or itemized deduction, but it's not going to change your tax brackets easily at all. And so that is why in tax plannings, it's very important to like consider how overall your tax earn income situation look like, and that's help you to make the decision whether like how much will be your W-2 earning as a S corporation or C corporation business owner. Now we talk about like best practice for a owner compensation. So number one, need to understand what is your business structure or classification. Is it sole proprietor, single member LLC, a partnership, a C corporation, or S corporation? And number two, considers owner equity. So, like equities represent the net value of your business, which is asset minus the liability, and is on the balance sheet. Draw will reduce your basics in the business, and then that is why you need to make a very careful consideration. So, if your business have a loss and you also like draw a lot of money on that, that eventually reduce your basics in the business, become like zero or become a negative, which is not good in any situation related to like the equity at all. So need to be considered is very carefully. And then the next one need to determine like what is the reasonable abroad compensation. This is put in tax plannings, in earned income, in tax brackets, in terms of like business structures. And it's also like if you are an S corporation owners, it need to be also comply to the laws that is the reasonable salary as an S corporation. And I probably should like explain more in terms of what is reasonable salary. But basically like the S corporation give the business owner an option to become like a small business corporation. And so that is why you have advantage in terms of tax. You don't pay the self-employment tax, which is normally 15.3% on the net profit. You just only pay on the salary that you pay for yourself. And so the IRS always like careful because people will like take advantage of the rule that they pay themselves, like for example, $10,000 or $20,000 in terms of income. And once you pay yourself like ten or $20,000, the Social Security and benefits and Medicare, which is self-employment tax, will be like very small, minimal, and they don't want that. They make sure that you pay a reasonable salary, so you pay the self-employment tax on that part. But when we talk in the episode that about S corporation, we probably will discover like more in the detail how it look like. So now we talk about like how the implication for each entity owners. So number one, if you sole proprietorship or like single member LLC, you get tax on the net profits of the business. So regardless whether you pay yourself or you not, or you draw yourself or not, that is like you need to pay tax on it. So draw to yourself is not reduce your net profits, and therefore there's no like tax to pay on draw at all. Number two, if you are a partnership or like multiple member LLC, the tax is also on the net profits of the business, but the business itself, like partnership, normally don't pay tax on the federal level. But basically, the partnership like have the K1 for each partners, and then those K1 flowing each partner from 1040, which is personal return, and you pay the tax based on the K1 number. That is including self-employment tax and earned income tax based on their share of the profits. Number three, if you have an S corporation, distribution are not subject to self-employment tax, but shareholders, which is you as the business owner, need to pay yourself a reasonable compensation salary. Normally, the distribution to yourself is tax-free up to the shareholder basic. So, for example, in your business, you have the basis is $50,000 before distribution, and then you distribution for yourself, for example, $60,000. Then that $10,000 is higher than your basic in the business, and that's create the tax implication that you need to pay the tax on that part. Number four, I talk about C corporation. C corporation is totally different. C corporation doesn't give a K1 to the business owners like partnership or like S corporation at all. And any distribution, it need to pay tax two times. Number one is pay on the corporate level. And number two, when the shareholder receive the money, they need to be like on the individual, they will get tax. Shareholder pay capital gain on the qualified dividend. It's just like, okay, this is distribution now, and you pay capital gain on that dividend because it considers the distribution as a dividend from the C corporation. So basically, the key point to remember is understand the basic or equity or basis of your ownership in the business. And so when you take the distribution, you need to plan this carefully. Otherwise, it has tax implication on it. It's like distribution itself. Sometimes it doesn't have any tax situation on it at all. But so you have the choice whether you want to get the distribution like at the end of the year or like spread it over the year. That depends on the cash flow of the business and your personal situation. And anything that you distribute, make sure that you have a record keeping. And finally, like reasonable compensation at the S corporation business owners is very important too. So there's need to be a balance between like owner's salary and then the distribution itself. Then finally, we talk about like the importance of profitability. So small business cash flow is not stable all the time. Number two is distribution should come from the business profits. So your business needs to make some kind of like profits to like make the distribution for you. Otherwise, if your business always have a loss and then you take the distribution for yourself too, it will make the balances, the equity part become like a negative. And so finally, we talk about the impact of distribution. When you take a distribution, it's basically like create a negative equity transaction on the balances, like we say over here. So that is why you need to make sure that you understand how it's played a role in your equity part. And I mean, like everyone have a different situation, and so, and I understand like many business owner that have actually never read a balance sheet. So make sure that you actually read the balances and understand what they actually all this number is playing on. And the equity part, which is like how much is the thing that you have in the business. Make sure that you pay attention on it because it has tax implication. And also like in the future, if you plan to sell the business, what how the situation that affect the selling situation too. In conclusion, thank you so much for tuning into the episode today. And I hope that the information that helpful for you to like manage and plan your owner pay, your owner compensation, and the distribution. And thank you so much for your time today. And I'm looking forward for the future episode.